So this next conversation is going to be a debate, DeFi and TradFi, unifying divergent financial landscapes or building parallel worlds. And so first up, we have Dotun Rominiyi, Director of Emerging Technology at the London Stock Exchange. Welcome to the stage. We have Austin Muñoz, an investment partner at Amber Group. Welcome to the stage. We have Andri Rabetanety, COO of 1inch, and Mikko Ohtamaa, CEO and co-founder of TradingStrategy.ai, and our beautiful moderator, Emma Joyce, CEO of GBBC Digital Finance. Welcome, everyone.
Thank you very much. It's great to be here in Paris, certainly a city buzzing at the moment, and I'm honoured to be on this panel with my esteemed panelists. I think we've done introductions, so we could just jump straight into it, if that's okay, with my panelists. Okay, and as you know, we're here to talk about DeFi and TradFi. Are they going to come together, or are we building parallel worlds? Let's open the panel looking at whether the panelists think DeFi and TradFi are moving towards unification or building a parallel world. Andri, can I ask you to please start with your thoughts on this?
Okay, thanks, Emma. Glad to open the conversation. So I just want to level set on the tension between TradFi and DeFi. So it's very easy to look for divergence if you look at the definition of TradFi. So TradFi, traditional finance, has long been the backbone of the financial system, and at its core, you have financial intermediaries, financial intermediation facilitated by banks, broker-dealers, and hedge funds. And it's all about two simple things. It's all about investing the liquidity, their balance sheets, and the pricing of risk. All of this to do financial intermediation, to support credit provision, market making, and payments. So that's TradFi. And if you look at DeFi, quickly you see the tension there because it's all about providing decentralized and automated protocols that are streamlining those processes, and that removes the need for intermediation. So that starts with simple diversion from definition. But then if you look at the recent examples of what happened on DeFi, you see two basic use cases that are complementary. The first one, you will see TradFi players start experimenting with DeFi trade. And there you can see example of the project Guardians for JP Morgan, where they're trying to execute an FX transaction on a public blockchain. And on the other side, you will see DeFi players trying to implement TradFi blueprints. An example of this is the tokenization of BlackRock's ETF by Ondo Finance, where they actually underlying what they're doing is a traditional asset, ETFs, and also they use to tokenize their, in the tokenization of their token, they use a traditional structure that is used from the fund industry, which is called the LPJP structure. So my background is fund industry, that's why I mentioned familiar. But here we are, so we have convergence, divergence by definition, and convergence based on recent example. But I would open up to the others in the panel for contradiction or conversion.
Thank you. I would sort of echo similar sentiments. I think you sort of have a bit of a duality of activity in terms of sort of divergence when you look at sort of the asset classes and sort of where they're going. So obviously in the crypto markets, we've seen a lot of activity, depression of volumes off the back of some of the major collapses and sort of issues that we've seen in the space, looking at obviously the FTX collapse, the Luna collapse, Silvergate, etc. I think what we've started to see though is through that process and sort of successive market corrections over the years in the crypto space is this sort of increased and renewed interest in the underlying protocols and building out new capabilities and understanding how the market can start to solidify real value as opposed to speculative value in the assets, but in the technology and its ability to actually to deliver that. I think what's also been interesting as well is when you look at sort of the capital market sphere and some of the larger institutional players, we've seen a consistent increase in demand in terms of access to crypto as an asset class, but equally access to and sort of exploration of the technology and the value that it can bring. And that's certainly an area that we at the London Stock Exchange are very keen on exploring, specifically in the context of sort of tokenization of more traditional financial instruments. So, on an asset class basis, I think there is divergence, but I think there's a lot of convergence around the technology and around interest in the space collectively. Even with a lot of the larger sort of institutional players, there is increasing demand in getting into crypto as an asset class. But again, you have regulatory restrictions, market restrictions, prudential requirements, etc., that make it quite challenging, even infrastructure challenges in terms of getting in. But this will change over time, right? Is my assumption.
If I could just add to Dotun's point there, I think that right now we're seeing a divergence, and part of it is because of reputational risk. Institutional investors don't want to lose their job or look foolish over having gotten too involved with crypto, either because of bad actors or just because of poor financial performance. And so that's kind of a cyclical thing that we're dealing with, and that's pushing divergence. In terms of convergence, though, I think that more people are recognizing that a lot of the inefficiencies in traditional markets that are attractive to trade, things like excess volatility, high risk premiums, these are things that traditional finance traders understand well, and they're starting to recognize these things appear in crypto as well. And I think that that will, in time, push more convergence.
Yeah, so I come from a DeFi background and blockchain development, so I have a little bit opposite view on the converge. So I believe that eventually DeFi will win. It will actually eat TradFi and not vice versa. And this is just because of if you look at it from the higher perspective, if you look at it from the perspective of running operations and software development, because exchanges, they are software, brokers, they are software, market makers, they are software, and because DeFi is open, it's open source, it will bring the cost of delivering this software to zero. So eventually, everything will be commoditized, like in open source, like Linux operating system, and it means the cost of creating new exchange will be zero. And if it's based on smart contracts, you can also get the benefits that, okay, it's not going to ask for management bonuses, it's not going to have sales bonuses, so it's all about cost efficiency, and that's the only real yield we can do in DeFi. So if we can do things lean than the TradFi, then we are winning, and I believe it's simple to see that that's going to be the case.
Perfect, thank you. Dotun, please do.
Perhaps a counterpoint, if I may. No, I mean, I think it's an interesting perspective. I mean, sort of looking at that view from a capital markets lens, one of the things we see, in our space, of which there is a consistent drive from large-scale institutions year on year around operational efficiency, cost efficiency, right? But the challenge is, we have to think about more than just efficiency. Market protections, investor protections, market stability, competitiveness of the markets, all of these are considerations that regulators care about. Ensuring that we are able to meet the economic demands of sovereign states of which we operate and provide services to is something that we as market participants generally tend to care quite considerably about. And part of the challenge is the frameworks, the structures of regulation exist for certain reasons, and some of those reasons also incorporate a view of liability and protection against risk. And the challenge with technology is it doesn't solve for that, right? And it never will. So I think that there's always going to have to be a means by which, if someone loses some money because something happens, where does the box stop, right, from a legal standpoint? And there always needs to be an answer, and you can't turn around and say it stops with an algorithm, right? The law will never accept that, and that's always going to be the tension.
Dotun, do you think we're just early, though? Because I know the first three answers were about divergence, but there was, you were talking in there about regulation and tokenization, which we hear a lot about, and the actual technology. So are we possibly just early?
Yes, we are, but I think what's interesting when we touch on sort of the regulation side of things is the market's moving the other way, right? If you look at sort of the introduction of MiCA into Europe, we're seeing the introduction of a very comprehensive regulatory regime for crypto. There's talk of regulation around blockchain as a technology and technology more generally when you look at some of the innovations that we're seeing in the AI and artificial intelligence space. So I think the need for control, governance, over how markets evolve and how innovation evolves is always going to be there. I think the way that's sort of enforced and facilitated, technology can inevitably bring more efficiency into that, but I think there is some sort of structural need for certain players to continue to play certain roles, and maybe those players will effectively provide technology into the markets, right, as opposed to providing the means by which they enforce that manually, but we'll see how that evolves over time.
No, I think it's right. Like there's the need to get into a regulatory framework that actually works for DeFi, and especially that ties to the technological advantage, but also to lean to the decentralized nature of DeFi. But I do agree that there's a bit of a time difference, because TradFi benefit from years of overseeing the regulatory framework, iterations. A lot of different frameworks have been implemented to ensure consumer protection, but also system stability. So I think there's still that time of thinking what type of tools do we need in DeFi, what type of self-regulatory practices that we need, how do we build a monitoring tool, and all of this is actually going to take a bit time before we get to convergence of the two.
Thank you. We've touched on this briefly, but can we explore a bit deeper on the potential synergies and barriers to integration? Austin, could I start with you, please?
Yeah, sure. So talking to the synergies here, one thing that we look for at Amber Group with our fund when we're investing in companies or protocols is we look for folks who are using crypto technology and crypto infrastructure to actually enhance finance, the act of capital formation and allocation. So one example of a company that we think is creating this synergy here is Credora. And Credora is aiming to be the Moody's of crypto. And what they do is they use zero-knowledge proof technology to assess the creditworthiness of a borrower without revealing the private details of the balance sheet of the borrower. And so I can give a real-world example, which is that Amber Group is one of the world's largest market makers. We account for 3% or so of daily trading volume. And we actually use Credora to borrow capital more cheaply than we would otherwise be able to. And lenders are able to see our risk metrics as a borrower. They're able to see our position concentration, our venue concentration. They're able to see our VAR, value at risk. I believe they can even look at our like interest rate sensitivities, like DV01 or duration. And eventually they'll be able to look at our liquidity metrics, like basically like price impact if we had to sell a large portion of our portfolio in a short amount of time. They're able to see all of these risk metrics and assess our creditworthiness without actually seeing our specific positions. And that is very important because as a trading firm, we don't want anyone to know what we hold at any given time. So far, Credora has done quite well. They've managed to facilitate over $1 billion in loans. And these are, under collateralized. It's a real loan. It's not an over collateralized, putting $100 of capital down to borrow $50. It's under collateralized, it's real finance, and they've been doing well. And we consider them to be pushing the space forward, and I really hope to see a lot more under collateralized lending protocols and companies push the space forward, because that is ultimately really what finance is lending at the end of the day.
And to build on Austin's points, I think the focal point where there's going to be all the synergies will be around liquidity. Based on what you're saying, it's whether it's the creditworthiness, the transparency on the creditworthiness, or whether it is unlocking the illiquidity of private markets through tokenization of funds, or in our specific case on One Inch Network, we have the hypothesis when we launch our latest feature called Fusion Mode, which is just a method to do swap. The only difference is that the swap is actually, the swap orders are taken by professional market makers that we call resolvers. And the hypothesis here is that those professional market makers would come from the traditional finance world, and they will enable to enhance the liquidity that we find on the DeFi space. So by investing their own balance sheet, by providing more liquidity, they will be able to create those bridges of liquidity between the TradFi sector and the traditional finance sector, which will not only enhance the liquidity, but also foster collaboration, create more space where we can collaborate and create more effective market-making strategy altogether. But I think the point really of meeting for TradFi and DeFi is liquidity.
I think, sorry.
Yeah, it's a very good point, but it's also, I would see it as a intermediate step, because Uniswap is called automated market maker. Automated means that there is no market maker company. So eventually traders will be able to be market makers themselves, and the knowledge, the speed or whatever edge the current TradFi market makers have will be gone. It means that everybody can be a market maker, and then there's capital efficiencies because we are not paying the market making fees there.
I think just coming to the point around the barriers to convergence, I think risk is a really interesting one, and you can sort of look at that through a couple of different dimensions. I think certainly on the tokenization side, and even equally on the crypto side, I mean, the crypto markets generally, you see in the sort of capital market space, there is a lot of apprehension around handling crypto assets or gaining exposure to crypto assets, largely as a function of cybersecurity risk, as a function of handling risk with respect to sort of CTF and AML considerations, which are largely unsolved to today, right? I think what's also interesting when you look at sort of the tokenization side, the technical risks, the sort of information risk, knowledge, understanding of the technology and how to manage and deal with assets on the technology, governance around the assets when you're deploying sort of tokens to probabilistic ledgers where you may have forks, where you may have, let's say, interventions that cannot be rolled back. That's an operational concern. It's essentially a systemic concern. If you're a large dealer who deals with sort of supporting clients to issue $50 billion corporate bonds, you can't hold the liability of putting that on a ledger where someone could walk away with it and you have no cause of recourse. So these are some of the challenges, I think, that the ecosystem will need to overcome over time to better sort of see a growth of convergence, I would say.
If I could just add one point on the automated market makers like Uniswap. So I agree that this is a very elegant solution to allow someone to trade, anyone to trade, 24/7 on a smart contract. That said, it is not without costs. When you are trading on an automatic market maker, you generally get a pretty bad price just because it tends to have a lot more price sensitivity. Granted, it may be that it is a very liquid pool that you're trading into, in which case maybe you don't have that much price impact, but even then, for the actual liquidity providers themselves, you will suffer impermanent loss as a liquidity provider on an AMM, because like the mechanism of an AMM pretty much by definition means that you will be selling the asset that appreciates and you will be buying the asset that depreciates. So relative to where you would have been, with your original 50-50 allocation, you will lose money unless those two assets stay like almost perfectly in line, like don't change value relative to one another. So like it is an elegant solution, but there are still disadvantages of using it.
And just to build on your point and to answer as well, I think it caters also to different type of liquidity providers, where the MM is indeed an elegant solution that actually puts the burden of the risk-return profile analysis to liquidity providers that could be anyone that can invest in the liquidity pools, whereas there must be some institutional investors who will be looking at more sophisticated strategies, different type of inventory management that only market makers will be able to provide. So we are talking not about one replacing the other, but just in a world where, again, maybe jumping too far in the questions, but a world where the two can be there catering to different type of liquidity providers.
And I think that 1inch's new resolver program, where they're allowing market makers to actually, they're allowing users to place limit orders and have market makers, accept or not accept those limit orders. That's that enhances the automated market maker experience.
Absolutely.
You get the option of the two, really.
A quick extra question that I'm just throwing in, because we touched very briefly on MiCA earlier. Do we see regulation, or maybe particularly unclear regulatory regimes is a barrier to these diverging or not. Does anyone have any views on that at all?
Go ahead.
No.
Yeah, well, loose views. So this is a loosely held opinion here. Not speaking on behalf of Amber, just myself. But like, I question sometimes whether the regulatory landscape is truly unclear or is it simply inconvenient. Like, there are a number of protocols that have registered as securities, and they didn't last, but that's might have just been because they were not great protocols, you know? I think that there are probably some out there that could register. I think that if you're raising hundreds of millions of dollars in an entity and you're spending that on hiring employees and all this, like, yeah, maybe you could register, but that's US only, you know? So you don't need to be in the US to succeed. And so I think that for now it might be easier. Like, if you think that it is inconvenient, too inconvenient, and in many cases it is, then you should go outside the US. And honestly, I think right now that's where most of the demand for these projects is anyway. So, yeah, I don't know if it's unclear. I feel like the SEC has said, like, register it.
I can comment here that France is the future of finance.
Good, very good. So without expressing a direct view for what is currently happening, I do believe that that if DeFi is to attain like super mass adoption or mainstream adoption, there is a level of regulation or implementation of regulatory practices that needs to happen. The question here is how and what type of regulatory practices. What we are looking into and discussing with different partners is around self-regulatory practices that will tune more to the decentralized nature of the space, but you know, that's going to be a big question mark for the future.
Very quickly, I think ultimately, and just speaking in pure generalities, I think regulatory clarity, or the lack thereof, is inevitably going to be a problem for market participants, right? You want to build and scale a business, you want to know that you can sort of scale across different geographies, and it's difficult where, you know, one day and sort of national competent authorities saying X and they're sort of welcoming to the types of services that you're providing, and then the next day, you know, you have a change of regime, and then policy changes and sentiment changes. So it's not helpful for any business that's trying to sort of grow and innovate in that space. I think you're starting to see the solidification with some of these more comprehensive regimes coming into the forefront, hopefully a streamlining of that. And I think that will hopefully galvanize other regions to look to bring equivalent regimes in that can effectively bring sort of consistency, and both in terms of sort of horizontal consistency, but also time consistency as well, sort of moving forward around how this market can evolve. But yeah, it's certainly a challenge.
And there's one thing to be said too about whether or not all these regulations actually protect investors that much. Because I think, like, it goes unsaid that, or not enough people talk about the fact that there were, you know, I don't know how many SPACs that, or IPOs in the past 2 years that went out and had a 5-year revenue projection and traded at 12 times 5-year forward revenue or whatever. And yeah, that didn't do well. And they followed every rule in the book, and the result was probably worse than if they had invested in, you know, Dogecoin or whatever it is. So, you know, like, obviously I'm for investor protections. I don't want people to lose money that can't afford to lose it. But at the same time, I'm not sure if the current rules actually achieve that. I think that, unfortunately, people like to speculate. And it's really just like, they will seek out any medium through which to do so, whether it's sports betting or SPACs or Dogecoin.
Yeah, and just to add that all blockchains, starting from Bitcoin, it's made for peer-to-peer transactions. It means there's no middleman. So if somebody wants to speculate and there's access to internet, they can do it. Like, only way to really block it is that you actually start to control what people are doing in your country. Like, you go to a China model or Russia model, and do we really want to go there? Like, can we find a middle ground that, okay, maybe we allow this kind of activities, even if you don't know counterparty, and even if there's a risk involved, and even if it's different from what we have had for the last 100 years, but people want to do it, and that's the key.
So it'll be interesting to see what does happen, and sticking with that, who would like to give me their future predictions in this space?
I mean, I can start, like as I said, I think we were reading just a report from, PricewaterhouseCoopers, that crypto markets, including real-world assets, will be 15 trillion USD by 2030. And my belief is that most of that trading will happen on DeFi, so it's decentralized parties are slowly losing the ground. But the overall market will be massive, massive in the future.
I mean, looking at where we are right now, I think we are at a stage comparable to the FX market of, say, the 70s or the 80s. So my belief is that in the coming years, what's going to happen is something similar to, you know, moving from something that is less optimal to more optimal. But the way to do it is to have this market run parallelly to TradFi, just to find solutions to its own challenge. One be finding the right way to do regulations, but also I think, numerous new technological iterations that's going to come that we don't foresee it now, but that will come and change also the way we do DeFi.
Yeah, I think these are two excellent points, and you know, I think that in terms of my prediction for the future, in terms of you know, doing well financially in crypto, I don't think it necessarily relies 100% on the price of Ethereum or the price of Bitcoin. I think that people who are figuring out ways to allocate capital using crypto infrastructure, crypto technology, I think they can also make money the old-fashioned way, just by allocating capital wisely and doing it on a globally accessible way where anyone with an internet connection who can demonstrate their creditworthiness should be able to and can access that credit. I think people who unlock that will have great success regardless of where ETH and BTC are trading. I hope that that's the case.
Yeah, I think it's interesting. So when I look forward and sort of speaking on a personal note, I would say the crypto space will evolve. So the cryptocurrency markets, you'll see maturity, you'll see sort of regulatory settling of sort of controls and governance over that space, and it will mature over time. Crypto is small, and it will remain small in the grand scheme of things. You know, even if it reaches 15 trillion, which is sizable, but you know, you've got the sort of global equities market is around 144.4 trillion, global debt 159.6 trillion. And so I think what's interesting is what you'll see is a convergence around the use of the technology. Blockchain, for all its faults, is very, very good at facilitating efficient multi-party workflow interaction in a systemized way. Public ledgers, for all their faults, are very, very interesting from a global access perspective in terms of sort of increasing distribution and access to instruments of value. And I think what you'll start to see is the regulatory frameworks, the infrastructure emerge around the traditional capital markets, bringing those assets into that public sphere over the longer term. But I think equally, you'll have the sort of effect of the mutualizing of this set of common infrastructures both across the crypto space and the traditional finance world in the long, long term. But it will take a while to get there.
Brilliant, thank you. Do we have time for one more question, or should we move to one more question? Okay, fantastic. Shall we see if there's a question from the audience? Okay. Okay.
Oh, there's no mic? So you have to shout. Oh, no.
All right. Whoa. Thank you, everyone. It was a very interesting talk. For my side, maybe not so much as regulatory as a risk for TradFi and DeFi, more from the open source point of view, because I didn't hear much about that. And how do you see that? Maybe also Amber Group, how do you see that? Because currently, what's the reality is like I can, with my computer, easily train an reinforcement algorithm or whatever for trading. And how do you see your role? Because, I mean, the times are changing. It's not that you need a big organization for creating a trading strategy. Anyone at home at home can do that, and how do you see that it will affect your business, and maybe also like how do you see that stock exchange also like will change in the future? So
What was the last question? How will what change? Stock exchange.
Stock exchange, yeah, but it's more about the trading strategy because the time is changing, it's open source, and this is the reality that you don't need big companies. One person can build strategies. So yeah, how do you see that risk?
Yeah, I think you're right. I think that anyone can come into this market and do well. I mean, there are plenty of inefficiencies in crypto markets for everyone. I can say Amber has been doing well. I mean, I don't have the numbers for this year, but I know like first half of 2022, which is kind of depths of the bear market, we had 200 million in revenue for that half of the year. So like things we've been withstanding this sort of new source of competition. But yeah, it's something we have to be mindful of, and I think that it's success in trading and market making is partly about like making accurate predictions, right? But it's also like on the prop side of things, that's about making accurate predictions of relative price of tokens, whatever. But a lot of the success is about having infrastructure in place to reduce transaction costs, reduce like loss, like when like losing track of a wallet or whatever, things like that, like having everything very solid so that you're not making unforced errors. So that I think is where Amber's strength really lies. I think we're quite good at the prop trading and the market making, but the infrastructure it's hard to compete with as an individual just because it requires a lot of capital and time and expertise to put all that together. But I think, yeah, we welcome individual participants to come in and try their hand.
And maybe to also build on this, I think this is a great thing to have accessibility to all for trading and to gain exposure on the market. I think this is also a key component for DeFi. Definitely, I think TradingStrategy is helping here as well by building the opportunity to create algorithm for trading here. What I think is the different scale. So to do that on a low scale, typically it's feasible. It involves yes some investment into it, but as soon as you're trying to do this on a larger scale, that's a different ball game typically. So you can still access, but I let you.
Yeah, and I think just to pick up on that point, I mean, there is a sort of natural delineation between sort of your retail markets and your wholesale markets, regardless of sort of technology. I agree. I think there is a keen interest to see the evolution of democratized access to financial services, full stop. I think the technology is a great enabler for that, and I think hopefully that evolves not just in crypto, but also equally we see similar evolution and adoption of the technology to bring that accessibility into your traditional financial markets. You should be able to, in your bedroom, trade Apple as well, right? Why should you be restricted around the asset class? So 100% agree. But I think at the same time, when Coca-Cola wants to raise $2 billion, growth capital to be able to scale some part of their business in Brazil, they're not going to come to Bob in his bedroom, unfortunately.
But maybe they should.
Exactly. We can all own part of their factories.
Just a finishing comment for this one. I believe the guys are right, but in the end, trading is math. We know that computers are better in math than humans, and especially now when AI is coming, as only AI company in this conference, I believe like the white-collar workers are going to have a pain.
Thank you.
Wonderful. Thank you so much for hearing us today. I loved that discussion, actually. So thank you so much to my panelists. Thank you to you all here in Paris.
Thank you, Emma.
That was a lovely conversation. Thanks, guys.